Let's face it, the crypto community can be quite tribalistic at times. Coin tribes from different sides that rarely reach across the divide. Sometimes these differences of opinion can lead to chain splits as these tribes strive to find their own way. One of the most prominent examples of this is Bitcoin Cash, the most well-known Bitcoin fork that has been trying to forge its own path and identity. But can it really do this, and should it be considered? My name is Guy, and in this video I'll be answering just that, trying as best I can to cut through the noise and give you the most impartial analysis. This is also a crypto many of you have been asking my opinion on, so be sure to watch right to the end if you want my personal take on Bitcoin Cash. Now, two quick things, chaps. As always, please do your own research and make sure to speak to your financial advisor when making moves in crypto. This video was made purely as an educational resource. Guy ain't nobody's financial advisor. And if this is your first time joining us, welcome to the Bureau. Pro tip, hit up that subscribe button and ping that ringing bell. It's a great way to get my latest views the moment they hit the tube. And finally, I've been made aware that someone is trying to impersonate me with a Gmail account. Please be careful, guys. I will never reach out to you on email, so if you receive one, tell the scammer to piss off. Alrighty folks, enough pitter-patter. Let's crash into Bitcoin Cash. Now, before one can understand Bitcoin Cash, you have to understand the history of the Bitcoin fork, so I want to first touch on that. If, however, you're fully aware of the backstory, then feel free to skip on ahead with the timestamps that I've provided below. So, Bitcoin Cash's beginnings can be traced back all the way to a conference in New York in early 2017. At consensus in that year, many titans in the Bitcoin community came together to agree a scaling solution for Bitcoin. You see, even back then, scaling Bitcoin was becoming a challenge. Network speeds were slow and fees were climbing. They came up with a solution that was called SegWit 2x, which would increase the block size limits. And this is an important point because block size limit was the point of contention that led to the Bitcoin Cash split. Anyways, the SegWit 2x agreement would see Bitcoin adopt segregated witness in July, followed by a doubling of the block size limit to 2 megabytes in November of the same year. Oh, now for those of you who don't know what segregated witness is, it's a method of splitting transaction data, witness data, from the rest of the transaction. I've linked to our full post on it below. Anyways, there were many in the community who were not happy with the SegWit proposal and thought that an increase in block size was the only way to scale. This group included some high-profile investors, miners, and some developers. In their view, the only way to effectively scale Bitcoin was to increase the block size limit. Bigger blocks equals more transactions, equals more throughput, equals faster transactions and lower fees. So this group then decided that they would split the main chain, or fork it. On the 1st of August 2017, the code was forked and the Bitcoin Cash chain emerged. This would have an 8 megabyte block limit. Not long after this, on the 24th of August, segregated witness was enabled on the main chain. This was important as it would later enable second-layer solutions on Bitcoin, such as the Lightning Network. More on that in a bit. Oh, and that block size increase on Bitcoin to 2 megabytes never came. The community and developers were so against it that it was abandoned in November of 2017. But the big blockers already had their big blockchain, and that was Bitcoin Cash. Okay, so now you know how Bitcoin Cash came about, but let's take a quick look at the main ideological divide between its proponents and those of Bitcoin. The main point of contention that the Bitcoin Cash folks had, and still do have, with Bitcoin is that it cannot realistically be used as a medium of exchange. They claim that it is far from the roots of peer-to-peer electronic cash that was envisioned by Satoshi Nakamoto. You cannot conduct commerce with transactions that take over 30 minutes to process, or with fees that are equally high. And to a certain degree, they're right. Bitcoin had become unwieldy. During times of network bloat, these limitations seemed to become acute. Take a look at this graph of average transaction time. See those spikes in 2017 and 2018? Let's face it, not many people are going to wait around for up to 30 minutes for their transaction to process while waiting for a cup of coffee. And with a more bloated network comes higher fees as well. Check out this graph of the average fee paid on the Bitcoin network. There was a time in 2018 when the average Bitcoin transaction cost almost $50 in fees. Crazy, right? If you'd bought a coffee at that time with Bitcoin, it would have been the most expensive, cold cup of coffee you ever had. Now, of course, I'm cherry-picking extreme points in the data, and things have since greatly improved. But it's important to understand that it was these scaling issues that led to the frustrations felt by the Bitcoin Cash community. For them, Bitcoin was acting more as a store of value, where investors would just buy the crypto, sit on it, and hope for a price increase. And there is indeed validity to these points. Most coverage around Bitcoin these days is it being a digital gold with limited supply that only a few will own. If you are buying Bitcoin because you think that it will increase in value, why would you use it to buy something else? So it does not really serve the purpose of a currency. Now, I know what you're thinking. Why didn't the core developers and community increase that block limit? Surely no one is in favor of a slow network. It has to be a no-brainer. Well, not quite. You see, there are a number of reasons why many in the Bitcoin community were against this proposal. The first and most important of these was around the impact that it would have on the centralization of the network. So, let's quickly touch on that, shall we? When you increase block size on the network, you're also increasing the size of the blockchain in its entirety. This means that you're making it that much harder for average Bitcoin community members to run their own nodes. Already, the Bitcoin blockchain is pretty large at over 242 gigs at a recent count. When first setting up a full node, it can take hours to initially sync. Now, if you have larger blocks, that means much more data. And given that blocks are added constantly, the blockchain size increases at a rate 8 times faster, assuming the case of an 8 megabyte block. There could come a stage where members will choose not to run a node because of these limitations. This means only large mining farms and companies can run the nodes, which means more centralization. And as most in the crypto community know, centralization is a no-no. Another argument that I've seen made against larger blocks is that it could adversely affect the fee market. What do I mean by that? Well, remember that transaction fees are a free market where users are competing to be included in the next block. Larger blocks means less room for competition, which means lower fees going to the miners. Remember, miners earn fees and they earn those block rewards. As we know, Bitcoin block rewards are constantly getting smaller. Eventually, there will come a time where this block reward will be too small to incentivize the miners, and the only thing they have left to earn are those transaction fees. But if the transaction fees are too low, they're not going to want to compete. They are not going to hash the network past a certain point, which will mean a reduction in the underlying security of the chain. Of course, the latter is more of a postulation as to what could happen when block rewards are no longer relevant. Still some time to go. Oh, and while we're on the topic of block size limit, it's worth pointing out that Bitcoin Cash actually increased the 8 megabyte limit to 32 megabytes in its first hard fork that took place in May of 2018. The ultimate, my blocks are bigger than yours. Okay, so now you know a bit about the block size debate and the history. This is of course all theory though, and as we know, theory is often different from practice. Thankfully though, the Bitcoin Cash network has been live for almost 3 years, so we have a lot of data and information to work with. Has it been able to demonstrate its main use cases? Well, let's dive into the charts, shall we? I'm going to be taking a look at a number of the most important metrics that matter to those who want to use a P2P electronic cash. The first and most important of these is transaction fees that we've mentioned above. Here you can see the history of the average transaction fee on the Bitcoin Cash network. It peaked in January of 2018 with an average transaction of $0.9. However, since that time it has come down considerably. It barely even exceeds a few cents. Now let's take a look at the average transaction fee on the Bitcoin network over the same time period. Pretty high, right? And if we overlay the two, you can see just how stark it is. Here's another chart that has the Bitcoin transaction cost relative to the Bitcoin Cash fee. It's currently 466 times more expensive to transact on the Bitcoin blockchain. So from a purely transactional perspective, you can see that Bitcoin Cash is a much cheaper cryptocurrency to send and receive, so more amenable to a decentralized digital cash. Let's take a look at another metric, and that is the transaction speed on the network. Now, this one can also be a bit misleading. Most people will look at the transaction per second and total transactions on the Bitcoin network and conclude that it must mean faster TPS in general. However, this is just a reflection of the widespread use of the network. People are still using it extensively even though there may be slower transaction times. And the transaction times are indeed slower. I recently made a purchase with Bitcoin Cash and it confirmed almost instantly. A Bitcoin transaction of a similar size took me over 15 minutes. So, the Bitcoin Cash blokes have got that one going for them. Of course, the total transactions and throughput is important as it gives us an indication of the widespread adoption of the cryptocurrency in general. Taking a look at these charts, it appears to be quite stark. Despite the higher fees and slower transactions, Bitcoin is used overwhelmingly more than Bitcoin Cash. In fact, transactional demand on Bitcoin Cash has been so low relative to Bitcoin that it's not even filling up the blocks to the 8 megabyte limit originally set prior to the move to 32 megabytes. So, not so great on the adoption front there. On to the next metric though, network security, or more specifically, hash power. This is an important metric as the more hash power there is backing a blockchain, the harder it becomes to run a 51% attack. For those of you who do not know, this is when a group of miners who can control the network and launch what is called a double spend attack. Here is the chart of the Bitcoin Cash hash power. You'll also no doubt notice that recent dip over here. This was the impact of the April block reward halving that saw miners move away from the chain onto Bitcoin. I've actually covered this event in more detail in a separate video, which you can see right here. The long and the short of it is, the drop in hash power made it quite cheap to run a 51% attack on rented hash power. Take a look at those numbers compared to more established chains like Bitcoin and Ethereum. And this makes sense. If we switch over to the hash power chart for Bitcoin, you can see the amount of hash power supporting it. Many multiples of that of Bitcoin Cash. Sometimes Bitcoin miners do move over to the Bitcoin Cash network, but given the unique difficulty adjustment algorithm, they move back to the main Bitcoin chain pretty quickly. So on a pure comparison basis, yes, Bitcoin Cash is cheaper and faster to send. It has wide exchange support and is backed by some pretty powerful people in crypto. It also has an enthusiastic community that is actively trying to increase its adoption among merchants. Yet despite all of this, it's still nowhere near as popular as Bitcoin. The numbers don't lie, unfortunately. So then, the main question is, why? Well, because it is not Bitcoin. Pure and simple. Despite many of its advantages, it's not Bitcoin. There's no denying that the overwhelming interest both from the retail side and from institutional investors is in Bitcoin. Bitcoin Cash does get coverage and is able to get its message out, but it is definitely not as intently watched or followed as Bitcoin. Even when we were approaching the Bitcoin Cash halving in April of this year, no one was really following it. All eyes were still on the Bitcoin halving in May. Here is a chart that shows the tweet volume of Bitcoin versus Bitcoin Cash and Bitcoin SV. Pretty stark. Of course, just because Bitcoin gets a lot of airtime, it's not something against Bitcoin Cash. Bitcoin gets way more interest and coverage than Ripple or Litecoin or any of the other altcoins. And this is just on the retail investor side. When it comes to the institutional investors, it's quite clear that they know which Bitcoin they want to hold. From legendary stock pickers to large quant funds. from dedicated crypto funds to investment trusts. And on the financial services side, they are lining up to provide solutions around Bitcoin trading or investment. The CME lists Bitcoin futures. Bakkt has Bitcoin options. Fidelity Digital Investments is offering Bitcoin custody. So while Bitcoin Cash can be viewed as most aligned with peer-to-peer digital cash, Bitcoin is still viewed as the gold standard. Of course, these discrepancies in interest have not gone unnoticed in the price, so let's quickly take a look at that. I remember the crazy Bitcoin and Bitcoin Cash moves that we were experiencing in the run-up to the SegWit 2x activation in November of 2017. After the failed activation, Bitcoin started to collapse as Bitcoin Cash rallied to over $1,600. Take a look at this chart of Bitcoin Cash measured in sats. Pretty big rally there. I remember thinking to myself that it was unsustainable and would not last. Over the rest of the late 2017 and early 2018 bull run, Bitcoin Cash was quite volatile compared to Bitcoin. However, ever since its May protocol upgrade, Bitcoin Cash has been on a downward trend. There were momentary recoveries here and there, but all in all, a pretty bleak outlook. Even if we were to compare its price in sats with some of the other altcoins over the past 3 months, it has been quite lackluster. And as I covered in my piece on the Bitcoin Cash halving, the price reaction post-halving was a bit of an anticlimax. Prices of Bitcoin Cash started to fall in line with the decreasing hash power. So, can this all really be down to its lack of general coverage? Well, not really. You see, there was another important event that took place for Bitcoin Cash, and that was its own contentious hard fork. As most of you now know, there is another Bitcoin that occupies a top 10 position on CMC, and that is Bitcoin SV. And if you thought that the Bitcoin Cash fork was contentious, then the Bitcoin SV one was sure to shock. It was basically born out of a number of disagreements within the Bitcoin Cash community, prime of which was, you guessed it, block size. Seriously, what is it with these men and the size of their blocks? Anyways, in the case of Bitcoin SV, the block size was increased to 128 megabytes. I won't go into all the technicalities here. That's a topic for another video. But one cannot contend that the emergence of yet another Bitcoin fork has not muddied the waters even further. Prior to the fork, there was a clear ideological divide between Bitcoin and Bitcoin Cash. Now, Bitcoin SV has kind of thrown a spanner in the works. Moreover, because Bitcoin SV is also mined with the SHA-256 algorithm, it means that miners that would have chosen to toggle between Bitcoin and Bitcoin Cash now also have Bitcoin SV, which they can hash on. This is something that we have seen recently as miners have been ping-ponging between the two chains and arbitraging out that difficulty adjustment. So yeah, not the best outcome in my opinion for Bitcoin Cash, but it no doubt further bolsters support for Bitcoin. And speaking of Bitcoin, is it really true that it cannot scale? I mean, that is after all one of the reasons Bitcoin Cash was forked. Well, the answer is yes and no. On the core protocol, there has not been any development that could realistically scale Bitcoin. However, one of the most promising solutions to this is the off-chain scaling through the likes of the Lightning Network. Now, for those of you who don't know what this is, it's a separate payment channel where users can settle Bitcoin transactions almost instantly with zero fees. These payments are then reconciled or closed on the main Bitcoin blockchain later on. This is a simplified explanation, and I've linked to some handy resources on the Lightning Network below. What's important to note though is that there is growth on the network both in terms of network capacity and the number of channels. In a recent report by BitMEX, they reported that over 60,000 non-cooperative channel closures were completed. Pretty impressive. Now, it is of course also important to point out that it's not everyone's cup of tea. It is far from being user-friendly, and there is a lot of development that needs to take place before I see it becoming commercially viable. But it is one of the most exciting areas of the cryptocurrency space at the moment. Not the least of which is because it can help not only Bitcoin scale, but a number of other cryptocurrencies which it is compatible with. Of course, what happens with the Lightning Network is relevant for Bitcoin Cash as well. If it does become commercially viable, then Bitcoin can once again be used as an effective medium of exchange, not just a store of value. However, if it remains in its current form and your average Joe can't see themselves spinning up a Lightning node, then the arguments for Bitcoin Cash appear stronger. It's now time to wrap up this video with a few of my final thoughts. Bitcoin Cash is one of those cryptos that some love and others love to hate. I'm not on either side of that debate. I see the arguments for it, and I can understand some of the frustrations that some in the Bitcoin Cash community may have. Moreover, Bitcoin Cash is proving to be a more useful medium of exchange. I use on and off when making purchases online, and I've also used it here in London at point-of-sale terminals. It does have its use cases. However, when it comes to adoption potential, I still see it stuck in the shadow of Bitcoin. One cannot deny that the granddaddy of crypto always seems to steal the limelight. Moreover, miner support is seeming to wane, and that Bitcoin SV fork has made things a bit less clear-cut. Against Bitcoin, prices seem to be stagnating, and I don't foresee a reversal anytime soon. Everyone has their eyes on Bitcoin, and their portfolios appear to reflect that, including mine. In the end, whether Bitcoin Cash can forge a path forwards for itself really depends if Bitcoin fails to scale. So that's another thing that all of our eyes are on. This brings to a close my review on Bitcoin Cash. But what do you guys think? Was this a fair assessment? I'm keen to hear your thoughts in the comments below. And if you like this video, then like this video and don't forget to subscribe. I'm working on my next video, which you don't want to miss. I hope you guys enjoyed that video. But honestly, I have so much more that I want to share. Stuff that I couldn't really fit in this video, sadly. This is exactly why I've started a weekly newsletter. It's basically a compilation of all the interesting content that may have flown under your radar. News, reviews, analysis, and hot market tips. Want to join? Well, don't delay. Just scoot on over to the description where you'll find a link to my sign-up form. There you can enter your email address, hit submit, and hey presto, you're a Coin Bureau insider. My next newsletter is being worked on as we speak, one you won't want to miss. See you next time, chaps.